Today we are going to see three new topics. The first topic is going to be about what are the common mistakes made by investors while selecting mutual funds. Then second part we are going to see how can investors avoid making such mistakes and some of the things which they need to keep in mind before they sell mutual fund units. And finally, third topic which you should definitely watch is which are the mutual funds you preferably should be investing from 2025 onwards for various goals. So let us see the first topic. If you are someone who is looking to invest in the equity market via the mutual fund route, then you also need to be aware of what are the common mistakes done by investors today. And those mistakes are very similar to direct stock investing as well. But by knowing these mistakes, by knowing the mistakes which today's investors do while investing in the mutual funds, you can be aware of these mistakes and take corrective actions yourself. You can be wiser than the rest of the crowd. While checking in ChatGPT, I entered in ChatGPT how many investors have exited the market in January 2025. As you know, in the previous 3 years, the returns have been good enough, and a lot of people are talking about recession aega. So we're expecting the markets to be in a lull period. So a lot of investors, almost 60 lakh investors, have exited their mutual fund units in January 2025. Why? Now you may be thinking that mutual fund industry is growing. Yes, they are growing. But there have been investors who have exited, there have been investors who have entered as well in the same period of time. So net to net, there is a small percentage of people who have actually got added in the mutual fund industry. So keeping that industry growth aside, we know a sizable portion of the investors actually are exiting the market. So let us see the top three reasons why investors actually exit the mutual fund investing portfolios. So the top reason, the first reason is every investor mostly relies on the past performance of the mutual fund. Now, the past performance could be as high as even 50%, or it could be as low as 6%. Now, if it is as low as 6%, the mutual fund investor might decide, oh, it is giving 6%, so I will not invest in that mutual fund. Or it is giving 50%, so let me get into that mutual fund. Wow, I can expect in the next year, I can expect 50% return. Well, you are in for a disaster. A lot of investors commit this mistake. There have been a book, especially on Peter Lynch managed fund. Peter Lynch, one of the most famous investors, who had been handling his own fund of mutual fund, basically mutual fund collection of companies, and that fund managed to give a return of 30% year on year. 30%, can you imagine? But majority of the investors who have invested in that fund have got negligible to negative returns. Why so? Well, it was realized later that the investors who actually got negative to low returns, especially in the fund which actually managed to give 30% returns year on year over a long haul of at least of about 10 to 13 years, they realized that these investors who have made negligible to negative, they entered that mutual fund portfolio, they started investing in that mutual fund when the returns were at peak. They checked the previous year's performance, oh, it's peaked, let me enter. And in subsequent years, they're up for a disaster and then they exit all positions. So what do you expect? You expect negative returns. The same behavior, the same emotional behavior is being done even today in the markets. Now, human beings are very rational in most of the cases, but when it comes to investing, when it comes to their picking up of mutual fund or stocks, we are very emotional human beings. So when we see the value going up, we tend to run after it, and when the value goes down, we tend to run away from it. In fact, it should be the reverse. So this is the top reason why mutual fund investors ruin their participation in the bull run by exiting the mutual fund units. So now by remaining investors, we entrust our capital to the mutual fund manager. That's the whole reason, right? We don't want to do the investing. We want to rely on the fund manager to do the work. So hence, why bother about the market? The fund manager will be bothered about what happens in the market and take the corrective decision. If you have selected the right mutual fund under the right AMC, then of course there are professionals who are managing those funds. They will do the right thing with your money. So that was the top reason, relying on the past behavior, relying on the previous performance of the mutual fund. The second most common thing or common mistake made by investors is that they over diversify in investing in mutual funds as well. Why over diversify for mutual fund? At the most, you can expect to have 5 mutual fund across various asset classes. Now, well, we are emotional human beings. We hear from friends, friend 1, friend 2, brothers, sisters. We hear from cousins. We hear from uncle. We hear from other friends around, close friends. We see the performance. The friends say, hey, there's a wonderful mutual fund, and then we go ahead and buy this mutual fund. And then we end up with the over diversified portfolio of mutual fund, which is almost like 20 mutual fund. 40 mutual funds in some cases. I have seen 30 mutual funds at least invested by a specific retail investor. Can you believe it? Now, we need to realize that mutual fund is a collection of stocks. Now, if you invest in a large cap HDFC mutual fund, and if you invest even in an ICICI large cap mutual fund, you need to also check what is the portfolio allocation for both of them. If the portfolio selection of both of them, the set of companies with these specific mutual funds are managing are the same, then there's no point, right? You're still participating if you just be invested with HDFC or ICICI large cap. It really doesn't matter. So over diversification is another common mistake made by retail investors. So let us see now the third common mistake made by investors. The third common mistake, my friend, is we expect consistent returns year on year. That means we hear from the channel, we hear from the internet, we hear from newspaper, we hear from our financial planners as well, saying that we can expect 12% return average in the equity investing of true mutual funds. 12% average. Now what the investors start thinking is that, wow, that's 12% every year. This is the first year, I need to grow my money by 12%. In the subsequent year, 12%. In the second year, 12%. In the third year. Well, that's not the way the markets actually work. Now, let me put up on my screen some trend line related information. So it's going to help you visualize, it's going to showcase to you what is the performance of the Nifty index. The Nifty index, how did it perform in every year? So let us see on the screen. So if you see on the screen, you see from 2025, in year 2025, we got an annual return as of now of 2.92%. In the previous year, it was 8.8%. And then previous to that, 2023, it was 20.03%. 2022 it was 4.33%. And subsequently you can just see all the previous years up to like 2017, we have a return of about 28.65%. So in the previous 8 years, the highest performing year was actually 2017, wherein we got a return of 28.65%. And the least performing year, let us exclude 2025 because this year is yet to complete. In the least performing year, we have 2018, which is 3.15%. And across various months, the return percentages vary so erratically. I mean, there is no consistent behavior. But now, if you average the returns over the past 8 years, that means from 2017 to now, we have an average return of about 14%. But if you average out the, not average, average out, average out the return for the previous 3 years, that comes to about maybe roughly slightly touching 10%. So that's how the returns work over a period of time. So let's come back and reiterate. Let us see what are the top 3 reasons once again. So the first reason, as we said, was relying too much on the past performance, relying too much on the past data of the mutual fund returns. That is the first reason, that is the first common mistake made by mutual fund investors. The second common mistake made by retail investors is that they over diversify their mutual fund portfolios. And the third is we expect consistent return, as we have heard on the channel on the internet, every year on year मुझे वही ही रिटर्न आना चाहिए, otherwise I will exit. So you shouldn't be doing these mistakes if you want to enter the mutual fund industry. If you want to start investing in the mutual funds, then you should be avoiding these 3 mistakes. We have seen previously what are the common mistakes made by investors when investing in mutual funds. Now we are going to see how to avoid these mistakes. What is the most best way wherein an investor can avoid such mistakes? And then we are also going to see what are the things you need to be aware of when you want to sell your mutual fund units. So let us see how to avoid the mistakes which investors today commit while investing in the mutual fund portfolio. So the best way to avoid this mistake is to have goals, to have financial goals for yourself. I mean, if you have a goal like you just want to become rich, then if you see your capital depleting in the next year, you want to exit. There is no goal attached. It has just one single goal, as you want to become rich. Well, you don't know what the rich do, but you want to become rich. If you know what the rich do and replicate the exact behavior, how they have become rich, then you could as well become rich. But you end up listening to tips and tricks from different quarters of in the industry. So be a little mindful before you start investing. Start writing your financial goals. It might be education for your children, it might be a marriage plan, it might be retirement plan, it might be vacation plan, it can be anything. Just write your financial goal. They have to be smart enough. They have to be, when I say smart, it has to be specific, measurable, achievable, R, realistic, and T, it should be time bound. Now everything is time bound. This life is time bound itself. So once you have your goal, your whole actions should be towards meeting those goals. Your whole action should be towards saving for those goals, right? So now you should have bucketized these goals. You should have like three buckets of goals. One is your short-term goals of 1 to 3 years, and then you have a medium-term goals of 3 to 5 years, or maybe even 7 years, that range, and then 5 years or 7 years and beyond as your long-term goals. So within 1 to 3 years goal, you could have selection of debt or conservative mutual funds. You could expect returns of about 8 to 10% with very less volatility, very less risky. So you can achieve those short-term goals by being conservative with your particular capital. You do not want your principal amount to be, in too much negative area. If you are in the equity market, like it has happened in the just previous year or this year, we have seen the bull run and then suddenly the markets are going down. We have seen the trend line data. In 2022, it was a good performance. 23 was not so good performance. I hope I remember the years correctly. But nevertheless, you can refer back to trend line. You can see how the annual returns were. They are not having a consistent return, but average returns you could expect. Now, in the previous 3 years, average was about roughly 10%. But why would you want to take the risk of equity investing for 3 years if you have an equally performing, better performing asset which is conservative enough with less volatility for short term? And then you have a medium term, which is for 3 to 5 years or 7 years, wherein you could select hybrid funds or balanced funds, which is having a balanced approach to equity and debt. You could expect a good percentage of return so that you can fulfill those specific goals. It could be, children's education. You have children's fund plan as well, which has a lock-in for 5 years. Then you have retirement funds as well, which are hybrid or balanced funds, which have a lock-in of 5 years. So, but if you withdraw before 5 years, then you will be charged penalty or a very high exit load. And then finally you have a long-term bucket wherein you can invest for your long-term goal, which could be a vacation trip after you exit from your active work life, or it could be a retirement planning to fulfill all your lifetime expenses. So by having these buckets, your purpose then becomes oriented towards fulfilling the financial outcome of each and every bucket. It's not oriented towards checking what is the daily performance of the stock market. By doing it this way, then your whole focus moves towards saving. It could be in any instrument depending on your goal. So this is one approach of how you can avoid all the mistakes by just being focused towards the goal. Once you have achieved the goal, take it, then you go to the subsequent goal. You keep meeting each and every goal as you go along. And definitely a financial planner, financial advisor is definitely of great help, a great motivator if you want to invest in the mutual fund industry. So now that you have known how to avoid it, now we'll see some of the things which you should keep in mind when you sell mutual funds. Now when you want to sell mutual funds, there are three things which you need to be aware of. One is the exit load for mutual fund. Now coming up on the screen, you see the exit load for various classes of mutual fund. For equity funds, if it is redeemed within 1 year, it's about 1%. Then for debt, it is usually 0 after 7 days, right? And for index, you have 0% exit loads in most cases, and hybrid you have typically 1% within a year. Then you also have to be aware of the expense ratios when you want to buy, because expense ratio, you need to pay the fund manager, the team, they do various activities, they do valuation check, they filter out quality stocks for you, and they invest in the right companies, quality companies, so that your capital can grow at the expected rate of return to fulfill the objective of that specific fund. So let us see some of the expense ratios across different types of mutual funds. In the equity mutual fund, we see in the direct plan, we see maximum expense ratio of 1%. Then you have for debt, you have 0.8% maximum. Then you have for index, you have 0.3% maximum, and hybrid, you have 1.5% maximum. So these are the expense ratios which you need to be aware of when you're buying either a lump sum or a SIP. Then the third aspect which you need to be aware of about the long term or the short term capital gains upon selling your units. Now, if it is a equity mutual fund, which is the focus of this particular discussion, if it is an equity mutual fund, if you sell the units in less than a year, then it will be considered as a short term capital gain, and you will be charged 20% tax irrespective of your tax bracket. Whether you are in 10% tax bracket, also you will be charged 20% short term capital gain. So the benefit is that if you are in a 30% bracket, even then you will be charged 20%. And then if you have sold your units after a year, then you have long term capital gains applicable up to 1.25 lakhs per investors is exempted, and after 1.25 lakhs, whatever gains you have made after deducting the cost of the investment, then the gains whatever you have made, that will be taxed at 12.5%. So if you are in the 30% bracket, still you will be charged 12.5% of the gains. Even if you are in the least bracket, even then you will be charged 12.5% gain. So these are the things you need to be aware of when you either want to enter the mutual fund or if you want to sell the mutual fund. Now we come to our topic of which mutual fund we should be buying in 2025. Yeah, let's search our top 5 mutual funds which you want to buy in 2025. As I have told you earlier, your investing is goal based, short term, medium term, long term. So for every goal, depending on your expected return, depending on your capital to be invested, we need to decide the mutual fund. Now, you may be having low risk tolerance as well, or you may be having a high risk tolerance. So, depending on your risk tolerance as well, we need to decide the mutual fund. So, let us see, before I get into which mutual fund we need to start investing into, let us see some of the criteria which I normally look at before I invest in mutual fund. Well, the topmost is the past performance, but not the past performance of just 6 months or 1 year. It should be past performance of 5-year, 10-year, 15-year rolling. So it should be that long, at least 10-year performance I need to see for that mutual fund. That is one of the criteria which I typically look at when I want to invest in a mutual fund. Whether it might be debt mutual fund or it might be equity mutual fund, it doesn't matter, but I need to look at the past performance. The second criteria is to check the standard deviation, which indicates the volatility or the riskiness of that particular mutual fund. Now, if I want to invest for a short term or a medium term, I expect low volatility. The riskier the asset, the better the return. Less risk, less volatility, the lesser the return. So we need to check the standard deviation and beta of the particular mutual fund. So that is the second checkpoint for me. Then the third checkpoint is to check the Sharpe ratio, SHARPE ratio. And these things are available. If you go to Value Research, you find these ratios as well. If you go even to Money Control, you can find this ratio if you select the mutual fund. Now, what is Sharpe ratio? Sharpe ratio is for every risk that a mutual fund manager has taken, what is the additional returns it can offer you. So higher the Sharpe, the better the mutual fund in that particular category. And then finally, I see the Jensen's Alpha. How much additional returns I can get over the benchmark return. So that is my alpha. If the higher the alpha, of course, I can expect that much additional returns. Now, before I go further, let us take some example mutual fund when I can showcase to you why I would opt for a specific mutual fund and not the other. So let us do a comparison with ICICI uh, large cap mutual fund, and then we will see also comparison with ICICI opportunities mutual fund. So on the screen. So earlier I said large cap. I have actually taken a flexi cap. The reason is because we don't have to take a mixture of large, small, and mid cap as well. You can just have a flexi cap where you have a combination of all three. So instead of having three mutual fund elements, you can have just one mutual fund element if you want to opt for a mixture of all segments or across every category of stocks. So the flexi cap is just a replacement of large, medium, and small cap. So I have taken one flexi cap of ICICI Prudential, and the second is ICICI Opportunities. So if you see on the screen that ICICI flexi cap, it has a combination of like giant, large, mid, and small. In this percentage, 51% for giant, large is 16.22, mid is 16.03, and small is 16.23. Well, this is a fair enough kind of distribution. And then if you see at the different ratios, you see that the mean return of ICICI Prudential Flexi Cap is about 17.36%, and the standard deviation is 13.42%. Immediately then the alpha is just 4.47% with respect to its own category, right? Then you have the Sharpe ratio, which I have talked about, which is 0.83. It's not 0, it is higher than 0, it's positive, so great. Then now we go to the opportunities fund. We see that the distribution is little different from the flexi cap. If you remember from in the flexi cap, we had almost equal distribution across large, mid, and small, and the opportunities you have in the small, you have a very small percentage, that is 2.12%, and then the mid you have 21.41%, the large we have, and the giant you have 62.81%. That means this fund manager, according to me, is doing a fabulous job, because there have been news about small being overvalued, and it has been curtailed to 2.12%, and then the large giants were actually undervalued, wherein they have been entered. And then you see I really love the indicators here for ICICI Prudential Direct. We see standard deviation is just 12.58%, but the mean is 23% almost. So the alpha is like 10.51. In my opinion, this style of investing is actually more got to do with what is the value available in the market today. In my opinion, it is for me, it is not a suggestion or not something which you need to now just pick up because I said so. You need to definitely talk to your financial planner, your financial advisor, because it is very personal finance. You need to be oriented to your personal goals and then only select the mutual fund. So this is the way I analyze mutual fund and then decide which mutual fund I need to go ahead with. So definitely in my bucket there is ICICI Opportunities Mutual Fund. Please, either you can approach your financial planner or a financial expert for that matter, who has been doing for many years it would definitely help. So I'm sorry to make you disappointed for not telling you the mutual fund that you need to go for. For my specific goals, this is one of the mutual fund, ICICI Opportunities. This is not a promotion for ICICI, definitely no. I have not been paid anything. So you need to do the analysis based on the criteria which I mentioned and then pick up the mutual fund based on the goals. So I hope you have enjoyed this video and looking forward to keep interacting in multiple other videos on different aspects of equity investing. See you. Do read my book on investing. It's more about how you can pick up direct stocks. It also gives some suggestion of an alternate approach other than direct stocks. And the stocks which I have suggested in the book, that is Dodge the Recession, is more on investing altogether. It shows you what kind of portfolio allocation you need to have. So definitely it's going to be of help. It's a very easy to read language. It's a very easy to follow process which you can follow any year, any time of your career. You can read the book, and if you have any questions on the book, please reach out to me.